Meeting number 431, and I must apologize for starting beyond the time that was set for this meeting. We had to address some matters before we open our meeting, and we trust that our apology will be accepted. On that note, having welcomed you all to the special RC 431, it is held via Microsoft Teams, and it's held today, Monday, the 11th of May. And we do have an agenda for the open meeting, and that agenda is item 5. It is the only item that we have, and it's on municipal and private distributors tariff application for the financial year 2026-27. Members, by show of hand, can I get an indication that you do adopt that item that has been set for our open session of the meeting? By show of hand, please. Thank you, Mr. Majola. Mr. Mkhize and Ms. Maseti are also support the adoption. We then move on to the item on the declaration of interest. Any verbal declaration of interest that members would like to make? If not, members, may I request that we complete the forms that have been provided by the secretary of this committee, complete them and send them back to her, and to members of management and staff, please do the same and submit to the secretary. On that note, members, we can start with our item that is for the open session of our meeting. But before I do that, let me introduce the members of the REC, starting with myself. My name is Nomalanga Stole. I'm the chairperson of the REC and CEO at NESA. I sit on a number of committees and subcommittees of the energy regulator and the regulator itself. On that note, I'll move on to the other members to introduce themselves. I'll start with Mr. Mkhize. Over to you, sir.
Thank you very much, Chairperson. My name is Muzuvukile Wiseman Mkhize, Muzi for short. I would like to extend my greetings to you, Chairperson, the fellow subcommittee members, management and staff of NERSA, as well as the members of the public that are following us through the various live streaming platforms. Thank you very much.
Thank you, Mr. Mkhize. I'll move on to Mr. Majola. Mr. Majola.
Thank you, Chair. Thank you, members. And also good morning to the team at NESA. And also a good morning to all the members of the public. Thank you.
Thank you, Mr. Majola. I'll move on to Ms. Maseti. Over to you, Ms. Maseti.
Thank you, Chairperson. Good morning to you and the members of the REC and everyone on the call. My name is Nomfundo Maseti, and I'm the member primarily responsible for the regulation of gas. Thank you.
Thank you, members. On that note, I'm going to allow the executive manager for the electricity regulation division, Mr. Matebula, to just give a brief background on the process that we will be following in considering the applications of the license, the tariff applications of the licensed distributors. Over to you, Mr. Matebula.
Chairperson, good morning, and good morning to the members of the REC. Chair, we are continuing with the process to adjudicate on the tariff applications. Chair, for the 176 tariff applications that we received from the licensed distributors, municipalities, as well as private distributors. Chair, I must indicate that this was published on various platforms by the regulator for stakeholder consultation. We received in excess of 2,000 stakeholder comments through this process, which ended on the 21st of April 2026. Chair, I must indicate that out of the 2,000 plus comments, 678 were general comments from private individuals, which talked to the general concern of affordability of electricity in the country. And the rest, Chair, were analyzed and they were specific to specific municipalities. And as the presenters present, Chair, they will speak to those individuals and talk to how those were actually considered. Chair, I must indicate as well that these applications were conducted following the approved methodology by the regulator. And the approved framework. The framework itself, Chair, talks to two specific methodologies which the licensed distributors needs to follow when they process their applications to the regulator. And the same it's expected of the regulator to follow when evaluating these applications. And those, Chair, are the cost plus methodology as well as the rate of return methodology. Chair, the cost plus specifically looked at the allowable revenue requirement, which is determined by aggregating all prudently and efficiently incurred costs associated with the licensed electricity distribution activities, together with an allowable surplus. The methodology includes, among others, the cost of electricity purchases from Eskom, independent power producers, and also own generation sources. It considers the operating expenditure, the shared and support service costs, depreciation and amortization of refurbishment and capital expenditure. It considers repairs and maintenance costs and allowable energy losses. And these costs are assessed against the principles of prudence, efficiency, and cost reflectivity as prescribed in the Electricity Regulation Act and the approved NESA cost of supply framework. Chair, the second methodology, as I indicated, is the rate of return, which determines the revenue requirement based on efficient operating expenditure of the licensees, together with a reasonable return on the regulatory asset base. And the methodology takes into account operating expenditure, depreciation, working capital requirement, and the value of the regulated asset base, with the allowable return calculated using the weighted average cost of capital. This methodology is intended to ensure that licensees are able to recover efficiently incurred costs while earning a reasonable risk-adjusted return on assets utilized in providing regulated electricity service. Chair, in assessing this purchase cost submitted by licensees, NESA verifies the prudency and accuracy of the claimed cost through the evaluation of Eskom bulk supply invoices, power purchase agreements where applicable, and other supporting procurement documentation. The operating expenditure and shared costs are verified through the assessment of deforms, trial balances, audited annual financial statements, and the regulatory financial information submitted by the licensee. And this verification process is undertaken to ensure that only efficient and electricity-related costs are included in the tariff determination process. So, Chair, it is on that note that these applications that we are presenting before you have been processed by the licensee in the process of application, and also by the regulator in the process of evaluating these applications. So, Chair, the team, as they are presenting, they will talk to the other issues, specific issues for the specific municipalities. Chair, if you allow, I will hand over back to yourselves so that we can start with the process. Thank you.
Thank you very much, Mr. Matsibula, for that background. And on that note, I would like us to then start with our first applicant, which is a private distributor. It is Damplas Krachbron, and it will be led by Mr. Ralufe to the committee. Over to you, sir.
Thank you, Chairperson, and good morning to everyone in the meeting, all protocols observed. Chairperson, Damplas is applied on based on the existing COS, and it indicated that it consulted with its customers, and as well as from the NERSA side, we did the consultation and to solicit the stakeholder comments, but no comments were received from our side, and the municipality indicated the satisfaction from its customers. Damplas is based in the Free State and is a private distributor. It's based in the Free State in the areas of Petrastain, and it's supplying 164 customers. With regards to performance, Chairperson, Damplas has deteriorated on surplus. However, it's still operating at a surplus. It has deteriorated from a surplus of 23.84% to a surplus of 13.0%. Which is mainly driven by its cost base or OPEX, and which is of something good about it is still manageable since it's still operating at a surplus. Excuse me, Chairperson. And with regards to energy losses, Chairperson, energy losses deteriorated from 11.01% in 2023-24, and then they deteriorated to 19.86% in the 24-25 financial year, which is a good thing, and it's mainly due to continued maintenance of their infrastructure. And with regards to the losses, they lost a foregone revenue of 0.6 million, which is 600,000, and the improvement led them to a newly recognized revenue of 23,000. Chairperson, when it comes to results of the cost breakdown structure, and apologies after the instruction about stretching it so that all costs drivers are visible. When it came, Chairperson, the submission was already out. However, Chairperson, any information needed, it's here. It's here. And Chairperson, the total allowable revenue amounted to 23.3 million, and Damplas and the OPEX amounted to 10.9 million, which includes the depreciation of almost 0.9 million, and the profit margin excuse me, Chairperson, I got flu, and the profit margin of 1.9 million. Chairperson, Damplas is applying for 9.01%, and it only have two tariffs, which is the winter tariff and the summer tariff. Chairperson, let me conclude by ushering you to the recommendation. It is recommended that the tariffs that are based on the cost of supply report are approved as recommended in the tariff analysis section for implementation by the private distributor with effect from the 1st of July 2026. And the cost reported or submitted by the private distributor be noted, and the private distributor is required to submit a report accounting for all the costs that have been noted in the cost of supply to enable the regulator to perform its independent verification or audit process by the 2026-27 financial year. And finally, Chairperson, despite the losses being on a single digit, but the private distributor is required to submit a quarterly report on energy losses reduction, which follows the SMART principle to enable the regulator to monitor implementation in the 2026-27 financial year. By that presentation, Chairperson, I submit. Thank you.
Thank you, Mr. Ralufe. Members, any questions, issues of clarity, or points of enhancements on this particular application? If you have any, please do raise your hand so that you can make your input. Mr. Mkize.
Thanks, Chairperson, and thanks, Mr. Alpha, for the presentation. I think on the last part of the recommendation, we had already put it in place that we are going to look at smart efficiency improvement measures with a specific focus on the energy losses, but not just being limited to energy losses. And I take it that we take into account all the other enhancements that emanate from the previous presentations and discussed deliberations thereon. On that score, then I would be happy to support the recommendation. Thank you.
Thank you, Mr. Mkize, for that. The recommendation for is enhanced as indicated by Mr. Mkize, which we agreed to in our last sitting, to say that the municipality will be requested to submit a report on smart efficiency improvement measures on identified losses that they must submit to the regulator. So that will be the enhancements that is going to be done on that recommendation form. I do not see any other hand from the members. On that note, members, may I get an indication that you support the recommendations with the amendment of recommendation 4, and also taking into account that these will also take into account all enhancements made in previous applications. Thank you, Mr. Mkize. Thank you, Ms. Maseti, Mr. Majola. I'm getting a sound from someone whose speaker may be open. May I request that we check our mic such that we don't disrupt the proceedings. Thank you, Mr. Ralufe. We move on to the second application. It is an application from Mahareng Municipality, and it will be led by Ms. Tanda to the committee. Over to you, ma'am.
Thank you, Chairperson. Good morning to you, the members and the colleagues. Mahareng Municipality is situated in the Northern Cape. Municipality is applying for an increase of 10% across all the tariff category. Financial and technical performance is not satisfactory, as evident of the deficit and high energy loss. Municipality submitted the energy loss report, and NESA will continue to monitor and have engagement with Munich. The municipality submitted a revise its cost of supply, reason being the change in the tariff structure of Eskom municipality. Municipality used the cost plus methodology, taking into account the OPEX and the CAPEX, which related in terms of the depreciation. The municipality applied for operational expenditure, including the depreciation, amounting to 13.8 million. The municipality applied for a surplus of 1.4, translating to 9%. The asset value of the municipality is 160 for 2024-25 financial year, verified against submitted assets register. The audited annual financial statement of the municipality for 24-25 do not have a breakdown of the assets to the respective municipality business, such as electricity, water. They lump up all the infrastructure assets. The depreciation amounted to 3.2 million in the 2024-25 financial year, verified against submitted assets register. The projected for 24 projected for 2025-26 depreciation is 3.4. Then the 3.8 is the budget for 2026-27. The breakdown of the expenditure in table 5 are as follows. The depreciation is 3.8 million. The net work for repairs and maintenance is 3.8. Other expenses, which include salaries and allowance, fuel, safety, clothing, is 6.8 million. The municipality OPEX is 1.4, translated to 9%. The applied margin is 9%, although the return proposed by the municipality fall below the established target of 10 to 20. It is considered reasonable.
We have lost you, Ms. Tanda.
Sorry, Chairperson, I'm coughing. Sorry, Chairperson. Can I drink water? I therefore recommend the approval of the tariff as read as follows. The tariff are based on the cost of a supply report, are approved as recommended in the tariff analysis section for implementation by the municipality with effect from 1st of July 2026. The cost of supply study submitted by municipality be noted. The municipality is required to submit a report account
Chairperson, can someone assist Madam Tanda? Just asking.
Tanda, just see.
Sorry, Chair. Can I just maybe read the
Yes.
last two recommendations, which was to say that the municipality is required to submit a report accounting for all costs that have been noted in the cost of supply study to enable the regulator to perform its independent verification audit process by 31st January 2027. And the municipality is required to submit on a quarterly basis smart energy loss reduction progress report for the regulator commencing from the 30th of September 2026 to monitor implementation thereof.
Okay, thank you. And on that note, members, may I allow you to come in and give any input you would like to make in relation to this application? By show of hand, please. And Mr. Majola.
Thank you, Chair. Firstly, thanks to Madam Tanda for giving us that detailed breakdown of OPEX, the various components of her OPEX. But going back to the table of the requirements for revenue, I see she's got a line there which is called disallowed revenues. But when I actually look at the write-up, I do not see anywhere in the write-up where it explains what are the makeups of that revenue that was disallowed. So if you can just explain what is the disallowed revenue. Thank you.
Thank you, Mr. Majola. Ms. Masset.
Thank you, Chairperson. Chairperson, starting on paragraph 3.2, there's a table there, table 3. It's on page, looking at the green overstamped pages, page 46 and 47. Actually, on page 3, sorry, Chair. Chairperson, that table deals with the energy losses. I'm trying to, it's going very fast. My finger here, I'm trying to get slow. That table deals with the, yes, 3.2. It deals with the issue, it just shows the surplus or deficit as well as the energy losses. You'll see that the energy losses are actually going up. Now I'm looking at how this table is explained here, which is confusing to me. You will see on paragraph 3.3, which attempts to explain what is going on the table. It puts certain amounts, and you can see those amounts on the next table, table 4. The amount, for instance, of 11 million rands, stating that it has decreased. It's written in a particular way, but it needs to be rephrased. Municipal deficit would have decreased by 11 million. Something wrong if we take this, because from this table, when we do a revenue analysis, taking into account how much was spent, the expenses and the revenue in a particular year, and then we go to the surplus and the losses, how much revenue the municipality has forgone. That's what we're trying to demonstrate. But that first statement there to say municipalities' deficit would have decreased, it doesn't make sense, because if you look at that deficit there, it has decreased. Obviously, look at it. Okay, I don't know how to phrase it in a way that one could understand. It has deteriorated. It has worsened. I want to stress that it has worsened. So the way that the paragraph is explained, it is confusing to start off with, because we are trying to show the revenue that the municipality is losing, and then also as a result of the losses, so that the sensitivity test there can actually show that if the losses were to be improved, the revenue of the municipality would also improve. That's the first point that the Chairperson. And then the second point on that 3.2, it is not demonstrated anywhere, which is what we said must be demonstrated on the table of revenue analysis and the sensitivity analysis. We have a statement there that says the deterioration was mainly due to surge on expenses, mainly driven by ESCOM's interest of 3.5 million. The expenses themselves have not been included on the table, on table 4, for instance, which is where we normally deal with those expenses that I already stated. The revenue, the expenses, and then you subject that to the 12% and then the 6%, and then you will be able to see that is not there. I'm finishing up, Chair, and then if the third thing is to confirm that the interest, the ESCOM interest, has not been included here, and they must demonstrate that, because we would not know by just seeing the write-ups, and there are no calculations demonstrating this. That makes it a bit difficult for decision making, because this is something that we ought to have seen under the revenue analysis on paragraph 4.4.1.1.3. That is a bit of a challenge, Chairperson. I'm covered on the issue of what has been adjusted given these high energy losses. Otherwise, the decision will be a decision that takes into account inefficient cost without applying the risk-sharing principle, which we emphasized. Thank you, Chair.
Thank you, Ms. Maseti. Mr. Mkhize.
Thank you, Chairperson. I note the issues of the tables. First of all, just make sure that in the final RFD, the tables are numbered accordingly, because you've got this table 4, which deals with the sensitivity analysis on energy losses. And I think that we had agreed that the energy losses are on a ceteris paribus principle. That is, with all other things equal, you just look at that, and it's going to help to include in the final RFD you've got the input figures that you indicate there, but you have the energy losses as the 2024-25 financial year, and then you include the 12% as another column, and then the last column being the one on 6%. That would go a long way in terms of assisting. And the deficit, well, sometimes there's this challenge of the wording when it comes to deficit versus surplus. You've got an increasing deficit. So that is it's just how you need to write up to rephrase so that it talks to exactly what is happening there. Otherwise, I also do appreciate the good attempt you have made in terms of improving on the presentation of the data, and I take it that the amalgamation of the tables is also going to be done in terms of the enhanced table 4 that talks to the operational expenditure, and then you separate the depreciation and other cost elements that go into that, so to also indicate clearly what you have excluded. Thank you.
And thank you very much, Mr. Mkhize. I think for me, I just wanted to also say to the presenter, thank you for following one of the guidance that have been provided, in the sense that that 18% and 82% on the table on the required revenue has been explained in the submission, and we have been requesting that the teams do that, alternatively explain that verbally, and on this one it has been done. That was just one of the points that I wanted to highlight from my side, that I trust that all of the presenters are noting that. On that note, members, the recommendations have been read into the record. May I get an indication that
there's no response to the questions and they affect the decision. You have not yet allowed the team to respond. Thank you.
Okay. Dr. Matebula?
Yeah, Chair, I just wanted to start so that I'm not sure if Ms. Tanda is on the call yet, but her colleagues will also assist. Chair, I wanted to start with the table 3, and just to indicate, how the interpretation is, and I know it can be written differently. So on table 3, Chair, we have got 2 rows. The first row is the percentage surplus, and in brackets we wrote deficit. So it can either go positive or negative, and when it's positive, then it becomes a surplus. When it's negative, then it's a deficit. So at this point, I think we can see that the deficit has increased from 3761 to 73.89. And on 3.3, what the team is attempting to explain, which maybe it would have appeared properly if it was on a tabular format, is that if the municipality had their surplus or deficit managed within the required range, they could see or they could save an additional 11 million, and that would reduce their deficits that is currently sitting at -73 to -60. And then the team continues to say that when they look at the issue of the Eskom debt, and if the municipality didn't have this interest, which is reflected on 3.2, which it needs to pay, and it had kept its losses below the 12% range, it would actually have operated even at, it will still have operated at a deficit, but it will have been a lower deficit of 5.78. So that is how the team has attempted to sort of clarify this part of the performance indicators. So, Chair, as I said, it can be written differently to ensure that it is well understood to whoever is reading it, and I think we will do that before the RFD is finalized. But Chair, let me allow, if Ms. Tanda is back, she can talk to other matters that I have missed, as well as the colleagues of Ms. Tanda, which is Mr. Alufe and Ms. Masike. Thanks, Chair.
Thank you, Mr. Matsubula. Ms. Tanda, is she back? If not,
Yes, I'm back, Chairperson. Apologies, I have a glitch of a network. Mr. Matebula have explained the energy loss part, and I'm happy with the explanation. And then I couldn't hear Mr. Majola's question or comment.
Just to assist you, Mr. Majola's point was in relation to the table on the revenue requirement. And the question was the cost of losses disallowed are not specified. So he wanted to know as to what exactly are those costs of losses that have been disallowed. If you can address that particular point and also enhance that part accordingly. But come in and explain to him what are those costs.
Okay. The disallowed cost is the energy loss, since the energy loss was 40%, and then it is limited to acceptable level according to the COS model to 12%. So those costs are disallowed because are the inefficiency, and another inefficient cost that are disallowed is that 3.2 of the ESCOM interest, because it is within the municipality to manage the ESCOM account properly. I thank you.
I'm not sure if there's that has not been addressed. Mr. Rufe, please do come in. I will then follow up with members. Check with members if they've got any follow-ups. Please do come in.
Thank you, Chairperson. I wanted to respond on the issue of cost of losses disallowed. Cost of losses disallowed, Chairperson, how the framework and the COS are crafted is losses are efficient up until 12%. So anything beyond 12% is deemed to be inefficient. So how the model is crafted, or rather how the framework is crafted, is to say we can allow the municipality to have losses, or rather we can allow the licensee to have losses up until 12%. Then that we can allow and give them a credit on. But anything beyond 12%, then it will be deducted against the municipality's revenue. Hence, that cost of losses disallowed, Chairperson. It's basically all losses beyond 12%. I think I will end there. Thank you, Chairperson.
Thank you. So, Ms. Maseti.
Thank you, Chairperson. Chairperson, the answers are not actually clarifying the issue that Mr. Matchell and myself indicated. We know, we've seen on the table that they are talking about approximately 2.9 million that has been disallowed. Obviously, that 2.9 million has not even demonstrated anywhere in the document to show how it was calculated and arrived at. That's the first thing. The second thing is that when we say that we disallow it, it does not show where it is supposed to show. It does not show on the table. Mr. Machola is right, and I also touched on that because he covered it. If you say you disallow, then you must go to the table that is on page 48 and 49. That table must show that as you added all of the other things to arrive at that revenue that is required, there's a total of what, how much revenue there is, a total of 45 that they're told there's total cost, and then there's a 42 that is on top, 42.8 million. Now, what's happening if you look at it? The 2.9 here, how do we show that it has been disallowed? Because if you look at the total, there's total cost here. And then there's the 42 million, and then the 45 million. So how do you show that you have disallowed? By highlighting it in blue, or what exactly is it? And then where does it show that the ESCOM interest has also been disallowed? Because this one is characterized as the losses only for the energy losses, and then it doesn't show the ESCOM debt that the interest and the debt that is disallowed to make up that revenue translated into a tariff. That's the major issue that is not coming up.
Stanley coming, and please do remember the request from the committee to say that any line item that has been listed without really having dissected it in a manner that shows the list of the components within it, you can read them into the record. So if you can do so in terms of that cost of losses disallowed and the other points that have been raised by the members. And if there's a paragraph that you can direct the members where you've covered what's being asked, please do so. Over to you, ma'am.
Thank you, Chairperson. The interest, the ESCOM interest that is being disallowed, it won't show on the revenue requirement because the revenue requirement is for the year year zero, and the interest of ESCOM, that 3.2, it's only included on the cost of supply in the year zero when you have to do the projection for the other years. So automatically it was not included. But the energy loss, which is capped at 12%, is calculated on the projection is that this is the cost of 2.9 that is allowed. I will enhance the table to include the calculation that the total cost of 45.7, and then we disallowed the 2.9, and then the allowable cost will be the 42.8%. I will enhance the table.
Okay.
Thank you.
So that paragraph 4.1 may have to also be enhanced in line with the changes that are being requested. And let me take on Mr. Mkize. His hand is up. Mr. Mkize, may come in.
Yeah, no, I'm covered now because the main thrust of my comment was on us building on the foundation that you've already laid to say enhance this table 4, in some instances table 5, right? Enhance it so that you can indicate the costs that are involved and even those that have been disallowed, so that it is clear that this is indeed an efficient level of increase that is being requested. And also even on the tariff, the tariff structure that you have at the end, that other table, it's table 6 and table 5 in others, to also indicate that the municipality had initially had this amount of increase, but in considering the issues of affordability, this is what they came to. Because we have also stressed that, yes, there are many comments that have come through that deal with affordability. And it's not that we've just not duly considered them. They've been duly considered, and then they find expression when one looks at what the municipality initially requested, but then how it has been adjusted in view of being able to accommodate and deal with matters of affordability. Let me leave it at that. I take it that the team is also going to work together in terms of ensuring that there is consistency and these matters are taken care of in terms of enhanced tables. Thank you.
Thank you, Mr. Mkhize. Mr. Majolo?
Thank you, Chair. For me, just to re-articulate what Mr. Mkhize said, as well as Madam Maseti, and also to help Madam Tanda, when we talk about this table of the revenue requirements, and when we're actually talking about enhancements, I really think she must have a look at one of the submissions, which is still going to come later on, you know, and I'm looking at that municipality called Nala, and you will see there, as the members have been saying, Nala has in their OPEX, you can see clearly in their table, ESCOM debt, interest, and I'm not going to read how much it was, but you can see there was a number there, and they can show you what it was actually taken away. So when we actually say enhancing the table, what we are really saying is, if you can have a look at how your other colleagues have done it, and I'm just saying Nala, but I'm pretty sure a whole lot of other municipalities that we're still going to hear today are probably going to be expanding it same way as Nala. So if you can just have a look at that table for Nala and enhance your table according to the way that other municipalities have done it.
Thank you, Mr. Majolo. Members, are you covered with those verbal responses that have been given on the question raised? Ms. Maseti?
Chairperson, to the extent that the disallowed amount is not demonstrated how it differs from the actual revenue requested by the municipality. So when you do the downward adjustment, it means you are deducting, you are subtracting from what the municipality has asked for. And it is not shown on that table. All of the other explanations, I'm hearing them about the enhancement. But what is what is key for the decision is the demonstration that they've asked for X amount. From the X amount, we had to disallow 2.9 million, for instance. And then the ESCOM interest and the debt is also not included. Then they put the zero, if they put the zero. Then the table 5, that is the key for the decision, must then show that it is less than what the municipality has asked for. None of that is on the table. And none of it that shows how much then the municipality will be given, having reduced the revenue that it has required. We've got nothing. But I don't want to delay the meeting, Chair. I will dissent on that basis rather than talking about enhancement here and enhancements there. I hear all of that. What is key is just the figures. What are we approving? The municipality asked for this amount. We disallowed X amount. Having disallowed X amount, what is now the total of the revenue for the municipality? And then from that revenue, that's what the tariff is going to be. But those adjustments are not shown. Thank you.
Thank you, Ms. Maseti. Mr. Mkhize?
Chairperson, in view of the efficiency of running with the meeting, because we are also taking consideration of all other factors, we've already set principles in place. I think that let this matter be addressed, let this join at the end of the queue. The team is functioning as a collective, and they can then be able to assist also in terms of that. so that we can be able to move with speed. And we've also it was the foundation was laid to say if there are these challenges, the presenters should just quickly opt for the submission joining the end of the queue, because if it should just be articulated clearly, if this matter of inefficient cost was addressed in the revised application, it should also be said clearly. Hence the reason then it would not show. If it's not the case, they should also show the difference. This was what was applied for, we adjusted and it became this amount, and this is the amount that we're bringing forward for as a recommendation. May you please just move on that. And I'm pleading with the next presenters, let's just make sure that we are very clear on these things so that we don't get to delay the meeting. Thank you.
Thank you, Mr. Mkhize. On that note, members, as guided by Mr. Mkhize, we'll stand this matter down for the team to go and enhance the paragraph 3.3 in terms of the response that was given, and with the assistance of Mr. Matebula, and also to go and look at the revenue requirement table, enhance it such that the cost of losses disallowed are indicated, and as well as the table, or rather the paragraph under 4.4.1, it's enhanced to really talk to that particular table. On that note, members, can I, by show of hand, get an indication that you have support that we stand this matter down? It will come later on. Thank you, Mr. Matrola, Mr. Mkhize, and Ms. Maseti. I support that. Ms. Tanda, I think we have given you the issues that needs to be addressed on this particular application. It will come at the end of the queue. We then take on Mohokare Municipality. Over to you.
Thank you once more, Chairperson. Mohokare local municipality is based in the southern part of the Free State, and it was operating under Centrelec, but now operating on its own. And Chairperson, Mohokare provided us with a cost adjustment tool to enhance or rather augment its existing cost of supply. And upon submission of the application, Mohokare indicated that it consulted with its customers. To date, we haven't got any comment coming from their customers, as well as NERSA. We consulted with the public to solicit the comments, but we didn't get any in this regards. Chairperson, like I said, Mohokare is based in the southern parts of the Free State, and it's supplying electricity to 4,094 customers. Of those 4,094 customers, there's indigents amounting to 1,173. And on financial performance, Mohokare's financial performance is not sitting properly, Chairperson. It's operating at a deficit of actually it was operating at a deficit of 5.87%, and it increased to 46.78. And the main drivers of this deficit, Chairperson, is the ESCOM interest of 5.9 million, as well as the notified maximum demand exceedance of 4.3 million, Chairperson. And when it comes to energy losses, it's they've increased from 20.47% in the 2023-24 financial year, and all the way up to 35.07% in 2024-25 financial year. And in terms of the foregone revenue, Chairperson, between the two financial years, it's 21.9 million, and the foregone revenue emanating from the increase amounts to 3.2 million. So the municipality has further experienced a foregone revenue that they won't recognize of 3.2 million. And when it comes to the municipal revenue requirement, Chairperson, I stand to mention the same apology happened to Dumplers. They were prepared the same day before the announcements could come, but the upcoming presentations will be reflecting everything and everything on the OPEX. It's just that the model allows us to minimize and maximize. However, Chairperson, the cost adjustment was analyzed, and adjustments were done on the two mentioned inefficiencies of ESCOM debt, as well as the notified maximum demand, and the adjustment resulted into the revenue requirement budgeted for of 74.1 million, taking a downward direction due to adjustments to 66.6 million rands. And Chairperson, operating expenses were adjusted, like I said, and the surplus as well, Chairperson, was adjusted. And Chairperson, as a result, the municipality applied for 11.01%, and the cost breakdown structure reflected that the municipality qualifies for 9.22%. And Chairperson, may I please take you to the recommendations in finalizing? Recommendations read as follows. It is recommended that the tariffs that are based on the cost of supply report are approved as recommended in the tariff analysis section for implementation by the municipality with effect from the 1st of July. And it is also recommended that the cost of supply report submitted by the municipality be noted. Thirdly, Chairperson, it is recommended that the municipality is required to submit a report accounting for all costs that have been noted in the cost of supply study to enable the regulator to perform its independent verification or audit process by the 2026-27 financial year. And finally, it is recommended that the municipality is required to submit a quarterly efficiency measures report, especially on energy losses reduction, to report progress report for the regulator to monitor the implementation by 26-27 financial year, and the report should follow the SMART principle. Chairperson, with that presentation, I submit. Thank you.
Thank you, Dr. Ragusa. Members, any questions, issues of clarity that you may have on this particular application? Thank you, Mr. Majola.
Thank you, Chair. Chair, I think we have to be consistent here. The previous submission, we said it must go back, it must go to the end of the queue to allow them to enhance their submission. And one of the reasons, for instance, was the fact that the ESCOM debt interest, which they disallowed, we could not see it in the tables. And if I had the current presenter very well, he said they also disallowed some ESCOM debt, but we cannot see it in the table, and we can also not see it even in the write-up. Because if it's not in the table, but if it's in the write-up, maybe that would be okay. So I suggest we stand this one down, let it go back to the end of the queue after they have fixed it, in line with the same recommendation we made with the previous one. Thank you.
Thank you, Mr. Majola. Ms. Masetti.
Thank you, Chairperson. My question, Chairperson, is on table 4. If I can be clarified on table 4, the purchases there, that 19.4 million, is it what you consider to be the inefficient amount? What's going on there? Because you classify that 21.9 million as the total, what to call this, as the, what to say this, attributable to energy losses amounted to 21.9 million. Is that correct, though? because in that amount, you've got the purchases from Eskom, you've got the sales amount, and then you've got an amount that represents the energy losses, then the average price, then you get to there's a 3.2 is it the percentage there, or what is that 2.2 mean? 3 rands, is it the 3 rands in terms of the unit? What exactly are we representing there? And then you've got the total loss, and then out of that you are showing that there is then the foregone revenue of 3.1. Is that correct though? I think there's something that you need to explain there, so that you extract properly the Eskom debt aspect and the amount that the municipality is able to get or recover from the purchases from Eskom. How much is it, from 60%, 70%? Because I suppose that's what you need to demonstrate there. That is the issue that you need to explain, and I think it will also explain the part on the 3 adjustments that needs to be made. The downward adjustment for NMD penalties, it must show how much that adjustment is, which is not demonstrated on this table. Then the third is the Eskom debt and the interest amount, and those for me. And then the third thing is the adjustment for the losses. So those are the 3 adjustments, downward adjustment, and you must show in each how much is the amount relating to each, and then how much is in total. Then you go to the revenue table, you then show that total adjustment that you have made, which then must reduce the total revenue required. I will leave it at that, Chairperson. Thank you.
Thank you, Ms. Kasufti. Mr. Mkhize.
Thanks, Chairperson. I take it that, on table 4, when it comes to the energy losses, it should be clear as to, because these are the losses that they must just put it at that number, because we've got 35.07 there as a percentage, and then I take it that it is the net of the 12% that should actually go there. In other words, it should be the 35 minus 12 that then becomes inefficient. But because this takes it as the whole amount and not necessarily that you're going to get to a 0. Somewhere you need to be able to then indicate that, because the number that is given there is a product of the energy losses in kilowatts versus the average, multiplied by the average selling price, which maybe it's because of the rounding off that does not give exactly the same figure that I quote. And that must be indicated. I take it that we are not necessarily saying that we're just simply putting these at the end of the queue. They must be able to demonstrate and at least articulate it when we are requesting responses. Because in some applications, you as a team, you have engaged the municipality such that the municipality brought a revised application. So make those things clear. And I think, Chairperson, for purposes of running the meeting efficient, again, I would say that presenter just be upfront and correct these things. If you're not getting the guidance clearly, please, let's rather spend time and do that, because once that is done, you should be able to move, very swiftly with this application. Because here, granted, well, these are not simple and straightforward matters, but they are more or less similar in how we deal with them, with some peculiarities in certain municipalities, and therefore let's run with them efficiently. Thank you.
Thank you, members. And from my side, and that they Rolife, because there's been a request that we stand this matter down. So when you come back, you will come back with all the answers that the members have raised, including the improvements on the tables that have been provided. And from my side, I did not hear you talking to the issue of the municipal public consultation processes. Because in the submission, we only talking about the NESA part of the consultation processes. If you can address that. Members, without really taking too much of your time, I would like to request that we stand this matter down. And in coming back, the presenter will address all the issues that you would have raised. On that note, members, can I get an indication that you support that? Mr. Ralufe, you want to come? I just want to manage the time now. Over to you.
Thank you, Chair. Thank you, Chairperson. Regarding the issue of Mr. Majola on adjustment, yes, it's not on the table, but the adjustment were narrated to in section 4.1.5 of this submission, when it comes to how the operating expenditure was adjusted. Yes, it could do. It was before we could get the announcement to say we must reflect the whole table, because we were initially presenting it minimized. And but all those issues are mentioned there: the ESCOM debt and the NMD. And even on table 4, Chairperson, it's a mathematical sort of an explanation to say it's the purchases and then less the sales. Purchases of 19.4 and less the sales of 12.6, giving us a difference of 6.8 kilowatts, which are the total losses for the municipality. Now, from the validation report, we have an average selling price of R3.22. And when we take the R3.22, we multiply it by total losses at 35.07%, we get a total foregone revenue of 21.9 million. Now, the further foregone revenue of 14%, it is the difference between the energy losses percentage between the 2 years of 35.07 in 2024-25 and 23-24, and the 20% in 23-24. That gives us a variance of 14.6%. So 14.6% of the total losses. This one is actually demonstrating that apart from the losses were at 20% in the previous year, now the municipality have further experienced a foregone revenue moreover of the previous year of 3.2 million. That is basically the narration around that, Chairperson. I thought I should give that narration, and then if there's a need for a review on the tables, Chairperson, I'm openly happy to do that. But I thought I should narrate on that. Thank you. And on the issue of consultation, I indicated at the beginning that the municipality indicated that it consulted its customers, but no response. But they didn't respond as to how the customers felt about the increase. And as well as from our side, we did advertise or rather published the application to solicit the stakeholder comments, but as well from NERSA's side, we didn't get anything. I thought I should narrate on that, Chairperson, and I'm sorry for taking that time. Thanks.
Yeah, now you have members, can you come in, because now you have responded to the questions which we were trying to say, let's stand down the matter. Mr. Majola, are you covered in terms of your question?
Just if I can just ask again, in terms of the question I asked, the presenter said it's somewhere. I can't remember which paragraph it is. If you can just remind me which paragraph he referred to.
He said paragraph 4.15 on page 71. Green stem, okay. Page 71, 415.
See?
Excuse me. Can you see it?
All right. Okay, I can see it, yes.
Okay.
All right, thank you.
You're welcome. Mr. Mkize, your hand is up.
Yeah, I was saying maybe in terms of how one articulated, this might not be understood. I understand what Mr. Randolph explained in terms of table 4. As I said, there could be a little bit of a difference between what I have and vis-a-vis what is here because of rounding off. When one looks at the average selling price, this, I think, to address the issue that I was trying to make it clear to him, is to include that sensitivity analysis table, which looks at the 12% and the 6%, because I could not see it here, and it's a matter of just augmenting that, highlight the other issues. So generally, I'm saying I understand where it's coming from, as again we issue of enhancement in terms of putting it in the table 4, that big table 4, and having that sensitivity analysis. Thank you.
Thank you very much, Ms. Maseti. Are you covered?
Thank you, Chairperson. I am covered with that explanation because he clarified each and every figure as we couldn't understand how he calculated them. So he accounted for each of the figures properly. And the only thing that I'm concerned about, and I will make a suggestion how it must be looked at, is the increase on the surplus. It is quite high, Chairperson, if you look at that line item. I don't think that little adjustment that is less than $1 million is actually good. Then there's a need for a further adjustment there. And I don't know why we adjusted it that by that small margin, when you can actually see that from the previous year how much it is, and then this time around, I mean, from 1.2 million. And it now goes to 6.1 million. That's quite excessive increase. For me, it makes me uncomfortable, especially if you take into account that this on its own is an issue. And position, the EPP position 54, it also guides us on those kind of issues, and that it must be ring-fenced so that the municipality can account for it and it be audited. That will be the way forward for me, Chairperson, on this aspect. It must account for that the amount that we are allowing of 5.5 million rands, and it must be ring-fenced as prescribed in the EPP policy position 54, if that can be done. Other than that, Chair, I'm comfortable with the adjustments as they have been clearly demonstrated on the table. Thank you, Chair.
Thank you, Ms. Maseti and the other members. On that note, members, the recommendations have been read into the record, and there are enhancements that have been requested to the presenter in terms of when they deal with the final RFDs, and one of them is on the issue of the surplus. It should be the municipality be requested to address it in line with provision 54 of the position 54 of the EPP. Members, anything else that you want to highlight? And if there's none, the recommendations have been read into the record, and with those enhancements and previous ones that have been made in other application, one of the important one being the adding a table on the rate design. And may I request that this be covered in the final RFD. On that note, members, by show of hand, can I get an indication that you support the recommendations as read out with those announcements made by members? Thank you, Mr. Mkize. Thank you, Mr. Majola. Thank you, Ms. Maseti. Apologies, I'm also coming up with a flu, and on that note, members, we'll move up to the next application, which is an application from Mole Municipality Kulani Makubele, Ms. Makubele, if you can take us through that particular application. Over to you, ma'am.
Thank you, Chairperson. Good morning to the members and good morning to everyone and also the public. Mule is situated in Limpopo. The municipality has a total number of 1,224 customers, mostly they're domestic, which accounts for 57% of sales. We receive NERSA received the application of Mule with the existing cost of supply, and is based on the cost plus methodology on the 31st of March. NERSA followed the notices and comment and consultation in terms of PAJA, and the Mule application was published on NERSA website on the 31st of March, and no comments were received. The application before us, it also went through the council, and the council approved the application of Mule, and also the meeting of this application took place on the 31st of March 2026. The council resolution has been submitted to NERSA, and the proof of customer consultation was also submitted to NERSA, and there was no objections or comments to object this application that is before us. To determine the tariff that is for 2026-2027, the total allowable revenue for this municipality is at 28.7 million, which accounts for 62%, and is also indicated on table 4. The actual figures were verified using the ESCOM invoices, and it was also verified with the DFOM of 2024-2025 that was submitted together with the trial balance and the audited AFS that was submitted to NERSA. The asset value of the municipality is estimated at 23.4 million, with a depreciation of 1.3 million calculated on the straight line over a useful life of 18 years. And all these were tested against the audited financial reports, including the trial balance. When we look at the deficit of this Mule municipality, the electricity business is operating deficit improved from a deficit of 25% in 2023-2024 financial year to a deficit of 20.98 in 2024-2025. And all of this information, they were sourced from the submitted DFOMs. Despite the improvement, the business of municipality remains fundamentally unsustainable. The reasons beyond that is the high operational overheads linked to a scattered network configuration, and also the high cost of skills recruitment and also retention due to the rural nature of this license. When we look at the energy losses of this licensee, there's a slight reduction in energy loss, bringing down the rate of 10.97 in 2023 to the 10.95% in 2024. And when we look at the bulk purchase expenditure of this licensee is sitting at 17.8 million, which accounts to the 62% of the total cost. The municipality is applying for a uniform increase of 9.01% for all their customers. And I'll go to the recommendation that is from page 81. From page 80 and 81, it reads as follows. The tariffs are based on the COS report, are approved as recommended in the tariffs analysis section for the implementation by the municipality with effect from 1 July 2026. The cost of supply report submitted by the municipality be noted, and the municipality is required to submit a report accounting for all the costs that have been noted in the COS study to enable the regulator to perform its independent verification audit process by 31 January 2027. The municipality is required to submit to monitor the smart plans put in place in reducing the high energy losses and submit progress reports to NERSA on a quarterly basis commencing 30 September 2026. Thank you.
Thank you, Ms. Makubele. The amendment of that fourth recommendation, just to remind everyone, it should read as the quarterly reports be submitted, or rather quarterly reports on smart efficiency improvement measures on the identified losses be submitted by the licensee to the regulator on the date that is provided on that recommendation, which will be starting from 30th September 2026. And that is one of the important standardized recommendations. On that note, members, can I get an indication in terms of any questions, points of clarity or enhancements that you may have on this application? Yes, Ms. Maseti?
Thank you, Chairperson. Chairperson, I just wanted to start off with those figures because that paragraph, just for enhancement to start off with, that paragraph that deals with the asset value as well as depreciation, because they are just put there as amounts without really showing. Because there was no asset register for verification of those asset values. But during the audits, if that those amounts can be verified, I think it's quite important, because we have no other way of knowing whether those could entail non-electricity business. And then the second thing that I'm concerned about is the issue of the high operational expenses pertaining to overhead costs. The overhead cost, I think, it's an area that the division must pay attention to when it comes to this municipality, so that they can reduce the cost. Because if you look at table 3, you will see that on table 3, the energy losses are not so very high. Yes, it's just a double digit, but they're not so high. But look at the deficit there. So it shows that there are other areas of inefficiencies that the municipality needs to address. And this is the time for the regulator to point out those areas of improvement, and so that if they are not addressed, the regulator can then take an informed decision. In any event, on the this 12% is not going to be applicable for this municipality, Chairperson, on paragraph 3.7. If that can be reworded or rephrased. Somebody's saying something. So 3.7 must be rephrased, because the energy losses at 10% is 10 point something percent, not even 12%. So it's below that minimum that has been indicated, if that adjustment can just be made. Other than that, Chairperson, and the importance of doing the audits for the next period for clawback purposes, I am fine with the proposed tariff increase. Thank you, Chair.
Thank you, Ms. Maseti. I don't see any other hand. Ms. Makubele, do you want to come in and comment on the points raised by Ms. Maseti?
Thank you, Chairperson. I've noted down what Ms. Maseti was saying. The paragraph 3.7 will be rephrased and also be enhanced on the final RFD, and also the point of the inefficiencies that should be addressed by the municipality, since their losses are not as high as they are double digit, but they are not too high. It will be emphasized to the municipalities to look at those other efficiencies that makes their deficit to be too high. And yeah, I'll stop here for now, and my colleagues can assist if there's something that I've missed. Thank you.
Thank you. I think you have covered. Mr. Mkiza?
Thanks, Chairperson. I think just to emphasize that when it comes to the last bullet point in terms of the recommendation, we emphasize the issue of not just being fixated on energy losses. There are other cost elements, and that remains throughout. and it's going to be important from our side to then ensure that we when we present, we might touch on some of these costs that have been identified that are undermining the improvements in some instances on the energy losses, as well as the issue that we are going to audit in terms of the auditing and further verification of the asset values and how then they then relate to the issue of depreciation that we present. It's on that basis that I would remain quiet on all of these things with that understanding. Thank you.
Thank you for those points of emphasis, Mr. Mkize. We have highlighted this in previous sittings rather as well, and also that enhancements of the recommendation for it shouldn't focus only on the losses, on the energy losses, but all other identified losses. On that note, thank you, members. We may then consider the recommendation if there's nothing. Oh, Ms. Maseti, your hand was up. I just wanted us to move to consider the recommendations. Over to you if you want to come in.
Thank you, Chair. Very quick, Chairperson. The same thing that we agreed on the surplus, it has increased, and the amount is also quite significant if you compare with the previous years. And remember that at this point we don't know what is that for, but because at least position 54 allows for ring fencing, so we can for now ring fence. The municipality must account for that, and that will be subject to clawback and the audit if that can be covered in the decision, so that it is clear, Chair. And then secondly, the that amount of 4.4 million that has been disallowed, if the presenter must just confirm that it made X difference on the revenue that is required. That is important, Chairperson, because we did not allow the other revenue. So once they deduct 4.4 from what the municipality has requested, it's important that they show then how much now is the revenue that we are allowing, and it translates to a tariff of X percentage. Thank you, Chair.
Thank you. Ms. Makwele, do you want to come on that point in terms of the 4.4 million that has been deducted and the impact thereof onto the tariff that has been applied? And I will also read the other additional enhancements on the recommendation before the members can vote. Do you want to come in on that issue of the deduction that has been done?
Thank you, Chairperson. I will allow my team member. She just raised the hand. Ms. Kopo, she will deliberate on that.
Okay, Ms. Nkopo, you got the question on the deduction done to the allowable revenue that has been determined, and also indicate the impact thereof to the tariff that has been requested. You may come in, ma'am.
Thank you, Chairperson. With regards to the revenue that has been deducted, it reflects the amount for reconnections, Chairperson. And then if you look at the allowable revenue with that deduction, we've got a 26 million revenue requirement, which amounted to an increase of around 26.56%. But since the municipality is applying for 9.05, so the adjustments were done to indicate the allowable revenue of that amount. Chairperson, thank you.
Chairperson, you're on mute.
Okay, thank you. Ms. Maseti, I wanted to say, are you covered? And I think I didn't realize I was muted. If you are, let me know.
Chairperson, I don't understand this generalization. I go straight to the point for purposes of helping the decision. So all that I'm asking, if the municipality asks for 20, because the table, and the reason I'm asking is because it is not shown on the table. The municipality, if the municipality is asking for 26 million revenue, now we are taking out 4.4. So it will mean that that revenue of 26 million has been reduced. So if it has been reduced, it must show that there's an impact on the revenue that was required or requested. And then as a result of that a lower revenue, it must translate into a lower tariff. That is the reason, and that is the fundamental decision that we have to take. I don't know why the generalization in answering and not just state what is this, so that we know what is the decision on the revenue as well as the tariff for us to make. Thank you.
Chair, maybe let me step in there to say I've tried to communicate same. I'm saying, please present us. You have indicated to us that in some instances, these figures have been taken care of prior to the finalization of the application, such that the application reflects that. That was my understanding. In some instances, you then adjust it yourself. And then in the adjustment, you come with something different. Please do indicate that clearly going forward. So we don't have to be going round and round the same thing. We don't have the luxury of time. Thank you.
Thank you, Mr. Mkhize. Ms. Makubelo or Ms. Nkopo? Ms. Nkopo, you may come in.
Thank you, Chairperson. Can I request that we enhance the table, Chairperson? And then we'll bring it back. Thank you.
Okay, thank you. And we'll focus on that enhancements requested by the members. On that note, members will stand this application down to have the team, give the team the time to address the issue that has been raised in relation to the revenue requirement made by the municipality and the deduction made and the impact thereof on the tariff that needs to be approved by the committee. Can we then move on to the next application, which is Nala Municipality? Ndate Rolufe, over to you, sir. Please take into account all the comments already made by the members. You may proceed.
Thanks, Chairperson. Before I present, I see Mr. Majola's hand is up, Chairperson.
Okay,
Yes, Chair.
you
Yes, Chair. Just to check, should we then not vote, indicate by show of hands that we support that this one be stood down? The previous one.
For that. Apologies. Yes, apologies for that, members. May we, by show of hand, indicate that we are supporting that the matter be stood down for the team to go and address the issues raised by members, and it will come at the end of the other application. Thank you, Ms. Maseti, Mr. Majola, and Mr. Mkhize. Thank you for that correction, Mr. Majola.
Thank you. With your less than a minute indulgence, Chair, if they can also look at that bad debts there, as well as that another depreciation line item. Thank you, Chair.
Chairperson, you're on mute.
Oh, talking on my apologies. The issues to be addressed is the requested revenue requirement by the Munich, the deduction that we have done of the difference thereof onto the tariff that has been applied for, the issue of the bad debt, and as well as depreciation. If the team can go and look into that and come and enhance their presentation covering those issues to the members. Thank you very much. And on that note, then we move on to the next application, which is Nala Municipality. Over to you.
Thank you once more, Chairperson. Nala Municipality is the municipality found in the Free State Province, and it's composed of 6,150 customers, as well as the 5,260 domestic indigents to whom it's granting 50 kilowatts of electricity monthly. And then moving speedily to financial performance, Chairperson. This municipality, Chairperson, it's one of the municipalities that are financially in ICU, and it's operating at a deficit margin of 67.71% in 2024-25 financial year, coming out of 75.23% in the 2023-24 financial year. Chairperson, I would like to indicate to you that the operational expenses of this municipality, Chairperson, they are 1.8 times its revenue. So basically, the operating expenses are growing higher or speedily than the revenue. And I would like to bring this to your attention that this municipality is having interest on ESCOM charges of 39.3 million, and its energy losses are at 30.69, poor collection of 45%, which is subsidizing other functions within the municipality. And this municipality is one of the top 10 owing municipalities to ESCOM, owing over 1.2 billion to ESCOM. As indicated, Chairperson, up there, the deficit it's actually seated at 75.23 from 67.71, and the losses are now at 30.69 from 29.34 in the 2023 financial year. And Chairperson, when it comes to the foregone revenue, the municipality, from the losses where they are, rather total losses of 30.69, it has lost foregone revenue of 56.9 million rands. So, Chairperson, based on the municipal performance, the municipal needs serious intervention when it comes to the state in which it's financially operating. And it has been indicated that, Chairperson, this municipality is on the debt relief program facilitated by the National Treasury. Chairperson, moving speedily to revenue requirement, the municipality requested for a revenue of 354.1 million. And then after the adjustment that have been done on ESCOM debt, or the ESCOM interest, as well as the notified maximum demand, resulted into an adjustment of 117.6 million, and that was adjusted as well in the operating expenses, and the narration have been stated. And this municipality is actually depreciating at 5.2 million per annum and on a straight line method. And Chairperson, the municipality has applied for 9.02%, and the cost adjustment tool is actually also, after the inefficiencies that have been adjusted, there's also resulted into 9.02%. With that, Chairperson, we recommend that approval. And Chairperson, finally, let me usher you to the recommendation, and it's recommended that the tariffs that are based on the cost of supply report are approved as recommended in the tariff analysis section for implementation by the municipality with effect from the 1st of July 2026. And secondly, the cost of supply report submitted by the municipality be noted. And the municipality is required to submit a report accounting for all the costs that have been noted in its cost of supply study to enable the regulator to perform its independent verification audit process by the 2026-27 financial year. The municipality is required to submit quarterly smart efficiency measures. Also an energy losses reduction progress report for the regulator to monitor the implementation by the 2026-27 financial year. Chairperson, with that presentation, I submit. Thank you.
Thank you, Mr. Alufa. Members, any input on this application? And thank you, Mr. Mkhize.
Thanks, Dr. Alufa. Thanks, Chairperson. Let's just ensure that the reference to these municipalities is them being in a critical financial position and disuse the use of the other terminology. I will just also emphasize that we have said that such municipalities are flagged for compliance monitoring and enforcement on our side, because whilst we're looking at these tariffs, we're not just narrow-minded in terms of just looking at the issue at hand, but we're considering all the issues that are within our purview to address. I would ask you, Mr. Alufa, to include the sensitivity analysis table. I note your paragraph 4.2.2. If you may just enhance that paragraph. And I think there are also some gremlins where you've put percentages where they seem to be duplicated in some instances, the percentage sign. Just to also to make sure that the costs are those that the costs that we deem inefficient, and that all these are still going to be subject to further verification in the auditing process. If you just work on those enhancements, it will assist. Thank you.
Thank you, Mr. Mkhize. Ms. Maseti.
Thank you, Chairperson. Chairperson, the first thing I would like to get clarity on is on paragraph 3.7, page 115, on the ESCOM debt of 1.2 billion rands. I do take note of the fact that this municipality does participate in the debt relief program. Just to understand whether there's any contribution that is made by the National Treasury there. That's the first part of the question. The second part is to find out how much of this debt is the municipality required, or is the municipality required to pay if they are getting some assistance, and how else is the municipality going to pay for that? And just to check if that is only in respect, yeah, it is in respect of the electricity. That's fine. So that's the first thing, and then the second question relates to paragraph 3.4. 3.4, you'll see that on the last line there, you've got 57 million. I understand that it is a rounded figure, but just be careful about it, because there's a couple of rands to it if you compare it with the total revenue loss of 56.8, right? So it's on the high. So I'm hoping that when we make an adjustment, we don't make an adjustment on 57 million. Let's rather use the 56.8. Otherwise, it will punish the municipality. So I suggest that let's just take and use that 56.8 instead of rounding it off there. Then the question then that I have here is, how much of this 56.8 million have you taken away so that you put this municipality to the 12% that you earlier indicated, or others have indicated, that we can only tolerate up to that 12%. We're not going to tolerate more than that. So out of this 56.8, what is the 12% of this, so that the rest then gets disallowed? that is all from my side, Chairperson. If that can also be reflected on the table, table 5, so that from that 56 we know how much is the figure, and then you add the disallowed cost from the interest Eskom debt, and then as well as the what you call the NMD accidents. Thank you.
Thank you, Ms. Maseti. Mr. Macho.
Thank you, Chair. And also thanks to Mr. Raluve. From my side, there's just a comment on table 5 to say thanks to Mr. Raluve for the way in which he has captured or the way he has prepared table 5. And it's very clear. Of course, I do note the issues that Madam Maseti has just articulated with regards to table 5 for you to enhance. But so far from my side, thanks very much, for the work you've done. Then notwithstanding the other issues that Madam Maseti said you must add to table 5. And also talking about table 5, because it's a whole lot of numbers. And when I relate it to your paragraph paragraph 4.16, where you actually explain very clearly what adjustments you have made. I mean, we can see. So if somebody's reading the table and then you go and look at the narrative in 4.16, they actually relate to each other. It makes it very easier for somebody to read your submission. So thank you.
Thank you, Mr. Mkhize. And I don't see any other hand. Dr. Ralufe, do you want to come in?
Yes, Chairperson, and thanks for the encouraging message, Mr. Majola. I will keep on doing the good work. Mr. Mkhize, I understand the issue around sensitivity analysis, and I also take the correction and withdraw the concept ICU, minutes in ICU, but I've heard it mentioned in many municipal forums. But I withdraw that and take the correction. Apologies. And Ms. Masedi, I haven't, or rather the team haven't took a deep dive into the debt relief program, which the Nala local municipality is one of the participants in. But if any further information is requested, we can engage colleagues from the National Treasury as well to take us through that, and giving the details of how much it's paying and how it's paying and over how long and how is it going so far. We can actually deliberate on them. We can deliberate with them on that. And on the last issue that Ms. Masedi raised, regarding the cost of losses are allowed, the table does reflect there as per the information provided by the municipality. And also variation of figures may arise, Chairperson, due to the audit principles. Sometimes when the auditors audited last of last year, and then they come back to audit this year, and then they put restated figures. So there's that variation. You find that figures from audited from the last year and the ones which are returned restated for this year, they do differ. But from the information we've provided, that is the standing. Chairperson, let me stop. Thanks.
Okay, thank you. And just on the debt issue as well, we can also maybe try and check if there is any discussion with Eskom with the aim of having the distribution aid. On that note, Ms. Maseti, you may come in.
Thank you, Chairperson. The only part I did not hear from the response is on that 56.8 million to say how much is the 12% of that amount, so that 12% then you add, you can allow, but the rest you take out. That's the part I did not hear. And then the second thing is on the line item that deals with operational expenses, including depreciation. You need to double check the figure there. I know that the municipality may have overstated or increased, let me not say overstated without proof, but what appears here is that for 2025-2026, it has doubled its operational expenses as well as depreciation. Those are two things. So it makes one wonder what actually happened. What happened there? So now the only issue that I have here, which if we look at depreciation alone, it might be problematic to adjust with the amount that we have used for an adjustment. Is there a reason why you even took away what we already approved, at least without verification? We have allowed them for 2025-26, 184 million, but you have taken a lot from that. It might be problematic without audits having been done. I'm not saying that don't adjust downwards, but just check that amount. Otherwise, it will be problematic. Thank you, Chair.
Thank you, Ms. Maseti. Mr. Rolefa, I think the section highlighted by Ms. Maseti for further clarity are clear. I won't repeat them unless if you missed something. Over to you.
Thank you, Chairperson, and thank you, Ms. Masedi. I note that, and we really appreciate your your observation in that regards, and even from us, from our side, in following what we actually need to do as a regulator to ensure that relevant and prudent costs are passed through to customers. We do eliminations, but I believe there's still a need for scrutiny in the figures, and maybe you made mention that they are not audited, and when the clawback mechanism is established and it comes into effect, that will also be looked into when the actual audited figures comes out. And when it comes to the issue of the 12% of the 56.8, when I did the calculation, it took me to 6.8 million, Ms. Masedi, and I thank you.
Thank you. I think, yes, Ms. Maseti, I think your points have been touched on. Are you covered? Thank you, Ms. Maseti. I see your thumbs up. On that note, members, the recommendations have been read into the record, and they are on pages 104 to 105. And with the enhancements that have been made, may I get an indication that the members support the recommendations as read out? And thank you, Mr. Majola. Thank you, Ms. Mkhize, Ms. Maseti. I also support. We then move on to the next application.
Just to make it standard, Chairperson, especially in a situation like this, that ring fencing of the surplus and subject to the audits, as well as that operational expenses and depreciation, because it's quite a big figure, Chairperson. Thanks.
Okay, and that will be added into the recommendation. You may have to assist me with reading the one on the depreciation, but the additional recommendation is on the high surpluses to be highlighted to the licensee, to ring fence them to ensure that there is compliance with position 54 of the EPP. And the one on the depreciation, Ms. Maseti, if you come in on that one.
Okay, Chairperson, on that one, that line item, what it shows, I was saying that for 2025, we had given them more than double compared to 2024, which was huge. I accept. However, for us to simply take it, without having done verification or audits is something that we must look at carefully. So we need to look at it as soon as we receive audited financials for 2025-26. Thank you, Chair.
Okay. All right. And thanks for that point. In terms of having to indicate to the municipality that there will be audits and verification that will be done once we have the audited financial statements on some of the amounts that have been highlighted in the presentation. Thank you, Ms. Maseti, for that. And then we move on to the next application, which is Nkomazi Municipality. Ms. Kekana.
Thank you, Chairperson, and I greet you all members of the board members and the public. Nkomazi Municipality, it's important to note that the submission is a resubmission. Nkomazi Municipality situated in Mpumalanga Province, they have revised their cost of supply study. They are applying for a 15.1% increase, and their percentage deficit is 24%, deficit of 24%, 24.96%. That has been reduced to 14.89%. due to an increase in revenue from sales of electricity and energy losses. It has energy losses of 7.1%. The energy losses have increased. The municipality opted to use the cost plus methodology aligned to the NERSA cost of supply framework. The municipality applied for 311 million revenue requirement and a surplus of 7.3 million. When verifying the cost drivers, the inefficiencies such as the municipality included ESCOM, interest of 8.4 million, bad debts of 3.9 million, of 3.9 million, and then there was no NMD incurred. So the operational costs including depreciation, were 86 million. The salaries, wages, and allowances were amounting to 35 million. Materials and supplies, 4.7 million. Contracted services, 250,000. The operational expenditure, excluding depreciation, was 73 million. The asset cost value of the asset cost value was 151.5 million as found in the audited AFS. The depreciation was 3.97 million using the straight line method, and the shared costs were 1.2 million, and consisting of FPE2, ESCOM, and general expenses. The risks identified were revenue collection risk, the risk of non-payment. There were no cross subsidies, and on the COS, there is an allowed surplus of 2%, ensuring that the surplus is not overstated by aligning to the policy position 1 of the EPP and COS framework. NERSA followed the PAJA. The NERSA followed the PAJA consultation process and undertook its own processes. No correspondence was received from the Munich of the comments received from customers. The recommendations are read as follows: as in our tariff analysis, we recommend that the tariffs based or included in the COS be approved, and that the members note the COS applied for the municipality to submit a report accounting for all that have been noted in the trial balance and audited AFS. The municipality and NERSA complied with the statutory requirement of the public consultation. Chairperson, I would like to remind the members that of the questions that were asked to me on Friday, I would like to respond to them after engaging with the municipality. So after engaging with the municipality, the questions were asked was what was the impact on this? What was the impact of the street lighting on the street lighting figure on the percentage surplus, and why was it so high? So the municipality confirmed that the figure to be correct, and they said that the figure is based on a formula that counts the number of street lights multiplied by the number of hours in a day and the wattage. Therefore, the figure is correct. They had 1,050 street lights, and they said it was important to mention that all those lights, they also supply lights to the N4 highway on the in Nkomazi. So those lights will consume a lot of electricity. And then the next question that was asked was why the losses are within the target range of 5 to 12%, but the surplus is in the low deficit range. So the energy losses, it's important to know that the energy losses percentage measures the energy efficiency, therefore measured in kilowatt hours. The percentage surplus measures the financial shortfall or financial sustainability, that is the revenues or cost divided by revenue. It is not energy metric. It is driven by tariffs, billing efficiency, collection rate, and cost structure. It is possible to have a deficit with normal losses. Yes, due to poor collection rates and tariffs not being cost reflective under recovery due to incorrect sales assumptions. Then the third question was why the costs disallowed in the revenue requirement are not reflected in the table for revenue requirement for revenue requirement. Then the revenue requirement, we had an engagement with SIA. SIA confirmed that the model was designed and formula driven to not reflect the disallowed costs in the energy losses that are within 5 to 12% to align with the COS framework. Therefore, the table will not show and be changed. I thank you, Chairperson.
Thank you, Ms. Kekana. Members, any questions, issues of clarity, or points of enhancements that you may have on this application? Members, I don't see any hands, and I take it that the submission and it was clear, and as well as the issues that were raised in the previously on this applications have been adequately addressed. And on that note, members, may I get an indication that you do support the recommendation, and that these responses on the questions that were read out will also be covered in the submission, in the RFD, to enhance them, together with any other enhancements that members may have made in this application and in other applications dealt with previously. Mr. Majola, thank you. Any other member? I do support as well. Thank you, Mr. Mkhize. I don't see a hand from Ms. Maseti. We will then move on.
Chair, on this one from my side, I will dissent on this one, Chair, as it appears inefficient costs have been included, given even the deficit that is there, and not doing anything to address the deficit and account on the revenue. Thank you, Chair.
Okay, thank you. Your dissension and reasons thereof will be noted accordingly. We move on to the next application, which is to Municipality. Mr. Mahlangu.
Thank you, Chair. Greetings to the members, NERSA colleagues, and members of the public on call. Ngutu local municipality situated in the KZN province. And Chair, in terms of the bulk purchases, Ngutu's revised COS study, which is based on the cost plus approach, projects a bulk purchase expenditure of 38.13 million, which accounts for 70% of total cost when excluding the 11% energy losses allowance. Bulk purchases were verified against Eskom invoices for 24-25 financial year. The municipality projected its bulk purchases for the 26-27 FY using the 25-26 FY Eskom tariffs as a base and made the following assumptions. The sales growth of 4% and a bulk purchase cost increases of 9.01% for the 26-27 FY, which is in line with Eskom's ERSA. In terms of the operational cost, the operating expenditure comprises of depreciation as a proxy for asset consumption and future asset replacement of 1.733 million. This asset value has been extracted from the 24-25 audited AFS, and the depreciation has been calculated on a straight line basis, relying also on the 24-25 audit deforms. And the second line item of OPEX is the network repairs and maintenance of 4.23 million. And the licensee is not incurring inefficient costs such as the NMD, accidents penalties, and interest incurred on Eskom debt. Chair, in terms of the surplus, Mutu's revenue requirement includes a surplus of 4.99 million, which is calculated using a surplus factor of 9% applied to OPEX, exclusive of bulk purchases. This margin was assessed against the municipality's risk profile to ensure alignment with the principle of cost reflectivity and financial sustainability. In terms of the risk factors, we assessed the following: revenue collection risk with current collection levels of 80%, which reflects low exposure to non-payment, indigent levies, and bad debts. Operational risk, including high energy losses of 20.71%, with major contributing factors being illegal connections, meter tampering, as well as the aging infrastructure. And financial sustainability requirements, including the need to maintain adequate cash flows for ongoing operations and infrastructure investment. In recommending a surplus, Chair, the analysis relied on Section 15.1A of the ERA, which requires NERSA to ensure that Mutu recovers efficient costs and earns a reasonable return while preventing excessive compensation. The return proposed by Mutu is considered reasonable as it falls within the NERSA COS framework established target range of 10 to 20%. The fact that the deficit continues to increase, Chair, even when the energy losses are kept, indicates that energy losses are not the primary driver of the municipality's surplus position. Other contributing factors may include under-recovery from tariffs that are not fully cost-reflective, high bulk electricity purchase costs, rising operating and maintenance expenditure. The municipality has cross-subsidization within its tariffs, with commercial customers cross-subsidizing domestic customers. As a result, the municipality will be requested to develop a cross-subsidy framework to ensure that there is fairness and transparency in its cross-subsidization component. Both the municipality and NERSA undertook public consultation, and there were no comments or objections received from stakeholders. As I conclude in the recommendations, Chair, based on the revenue output of the COS model, a tariff increase of 9% is required by the municipality. However, the municipality has resolved to implement differentiated tariff increases of 9% for domestic customers and 15% for commercial and industrial customers. RSC is therefore requested to recommend the tariffs detailed in the tariffs analysis section of the RFD for implementation by the licensee with effect from 1 July 2026, subject to the following change. Firstly, the cost of supply study submitted by the licensee to be noted. Secondly, the licensee is required to submit a report accounting for all the costs that have been noted in its COS study to enable the regulator to perform its independent verification or audit process by 30 September 2026. And lastly, Chair, the municipality is required to submit quarterly smart energy losses reduction progress reports for the regulator to monitor implementation thereof. Thanks for the audience, Chair.
Thank you, Mr. Mahlangu. Members, any input from your side on this particular application? Mr. Mkhize?
No, I'm covered just on the issue of the last bullet point. This is a standing amendment. I know Mr. Mahlangu read the old one, but there is an amended one with that and the incorporation of all other amendments or enhancements. Thank you.
Thank you, Mr. Mkhize, for reminding the team on that. And I think they have noted this down. Please do ensure that the enhancements that have been read throughout the other applications are covered and in the final RFDs. Ms. Maseti, your hand is up.
Thank you, Chair. Chairperson, just on the tariffs, especially the one that deals with on table one, the tariff that deals with domestic prepaid during high season. Even when you look at the blocks, Chairperson, the increase is quite excessive there. From block 1 to block 4, it's quite excessive. It's now 15%, and if you look at the rest, is 9%. So even if it's not high season, it's low season. Looking at the same, you've got 9%. How can it jump from 9% to 15%? Even if you're trying to constrain consumption, but you can't jump by that much. So the jump is about 6% jump. Really, it is burdening and it is just punishment to customers. So you can't during that season increase it in between, just increase it from 9% to 15%, a total of 6% increase. And in addition to that, there is a basic charge that also goes with it. So it's gonna be very difficult for the consumers to really afford that increase. So for me, it is those things, and one can actually see some of them in other blocks as well. That the other one is on page page 153. My issue really has to do with affordability and also where the reasonableness of that additional 6% during the course of the year when it comes to the high season to increase it like that. So I don't find the reasonableness in that percentage. So that's what I wanted to just raise, Chair. The other issues are the same, Chair, if they can just be addressed on the table, even the adjustment based on table 3, the adjustment of the deficit of 44.5%. It must appear on the table and be aligned. And I'm not seeing that the adjustment that is kept at 12% of the revenue. If that can be shown on the table, it is not showing like the others were actually showing, and the disallowed cost. In fact, the disallowed cost, their added share is 4.2 million. If you look at it, there's a bit of a problem. There is no adjustment that has been done on the revenue, and then also translated to the adjustment on the tariff. Thank you, Chair.
Thank you, Ms. Maseti. Mr. Mahlangu, do you want to come in?
Thanks, Chair. I note the enhancement made by Mr. Mkhize. To respond to the questions from Ms. Maseti, I will cover some, and then I will request Ntate Chabalala Mshengu and Ntate Ramolo to add if I might have missed some of the critical detail pertaining to the municipality. Or before I proceed, Chair, I see Mr. Mshengu's hand, Ntate Chabalala.
Through you, Chairperson. Good morning, members and colleagues. I just wanted to come in on the issue of the tariffs, Chairperson, on the issue raised by Ms. Maseti. You will find that a lot of municipalities, Chairperson, have flat tariffs where there are no, particularly for domestic customers, where there are no time of use tariffs, where there are no inclining block tariffs, apologies. So what we've been encouraging, Chairperson, in alignment with the principle of cost reflectivity, we've been advising municipalities to say that they need to be migrating more towards time of use tariffs to sort of align with the ESCOM in terms of how ESCOM charges them on the bulk purchase. So in the absence of issues such as smart meters, Chairperson, the closest thing is to differentiate. One of the things is seasonality, whereby your costs during summer or your tariffs during summer will not be the same as during the winter. So sometimes you can even remember in terms of ESCOM itself, we have just migrated from a ratio of as high as 1:8, meaning 1 in summer, and then the tariff becomes 8 times more expensive in winter. So if we do not allow for this differentiation in this tariff, it becomes increasingly difficult for these municipalities to cover their bulk purchase cost. And then in terms of the issues around OPEX, Chairperson, indeed, this is one of those prior adjustments Mr. Mathangu just did not mention, to say that the table will be expanded to sort of reflect in terms of the other elements or components making up the other expenses. Thank you, Chairperson.
Thank you, Dr. Chabalala. Members, have you been responded to? Ms. Maseti?
Thank you, Chairperson, for the opportunity. Chairperson, the essence of my question has not been covered, which is, I understand that the tariffs will be different in winter, summer, and so forth, those different seasons. The essence of the question is the reasonableness of the extent of the increase. That's all that I'm talking about. The reasonableness of jumping by 6%. So one must look into that as 6% is not insignificant at all. It's probably and already on the increase of 9%, you're adding another inflation-related increase on top of that. That's what I'm talking about. So all I'm talking about is the reasonableness of the extent of the increase. That's the point. And then, Chairperson, if again, which is something that affects the decision, just to look at it, we've got a surplus of that we have allowed on the wire business, 885,000. Then on the retail, and we're dealing with the municipality, on the retail, we allow the surplus of 4.1 million. That takes us to 4.9. We allow the entire amount, which is quite substantial. And there's nothing that shows that we're making an adjustment, a column, just like with the others, especially the one by Mr. Ralufe, showing the adjustment that we are making there instead of approving 4.9 without explaining what is that for and making sure that there will be accountability and ring fencing. So that item we need to speak to. And then again, Chairperson, on the, I see that on the operational expenditure, inclusive of depreciation, if you look at the table, that whole amount of 5.9 million is only assigned to the wires. So there is no operational expenses on the retail part of that municipal business. So is it zero? Because it shows it that it is zero. So they don't incur any expenses for retailing or even administrative issues pertaining to retailing. That one is problematic. It is also shown there. And then the other issue there is the adjustment based on the losses. I am not seeing that adjustment there. Whether it is when you compare what the municipality has requested and what we are allowing when we take all of these into consideration. Thank you, Chair.
Thank you, Ms. Masetti. Mr. Mkhize.
Thanks, Chairperson. I'm really at pains to request that the presenters that we stick to what we had put forth in the beginning. If there are changes that have come out of our own assessment, let's indicate them as such. I would say that it becomes kind of misleading sometimes, because if you've got these figures, you take it that was prior to the finalization of the application. Like you would say, certain figures or amounts are deemed to be covering inefficient costs, and they are excluded right from the get-go. But when the exclusion is after, it should also be demonstrated by way of these differences in terms of what you have applied for and what has been recommended. As well as we recall, Chairperson also spoke about street lighting, all those other increases, as well as the fixed charges, that they need to be post-approval probing on that one, as well as the auditing process. Because we also would like to move to a situation where it becomes clearer what we approve, getting closer to what the residents or the customers are going to see being in their bills. Let me leave it at that. Thank you.
Thank you, Mr. Mkhize, for that input. And Tate Mahlangu, do you want to come in, or Chabalala?
I will give it the first bite, Chair. So one of the enhancements or adjustments that we make, Chair, when a tariff increase is excessive, in our analysis, we would adjust or would use the NERSA previously approved tariff as a base, and then adjust by the tariff increase that the municipality is applying for. So in this particular instance, to enhance the tariff section, would apply that tool and also take into account the other enhancements that Ms. Masetti has made, and will further enhance figure 2 and table 4 to reflect as well the exclusions and the adjustments that Mr. Mkhize alluded to. One of the challenges that we experience, Chair, when we assess these applications, particularly for the tariffs applied for or tariff increases applied for by the municipalities, that they tend to, for example, include new tariff categories and sometimes apply for excessive tariff increases, but they do not demonstrate the social and economic impact of this decision to the affected constituent. And this happened to be the case with this municipality. So we will revert to the municipality as part of the enhancement of the application, so that they comprehensively demonstrate why the 6%, for example, in the domestic category, customer is this excessive. I'll park here for now, Chair.
Thank you. Members, Ms. Masetti, and everyone, are you covered? with those responses. And I think the team has noted the areas of enhancements and the concern on the 6% that is based on seasonal changes that must be looked at to ensure that it is reasonable. If it's not, this be highlighted with the municipality. On that note, members are seeing a thumbs up from Mr. Mkibo.
From my side, Chair, there's just an inaccuracy on the retail part of the business. It cannot be that they incur zero cost, and it is the first time that we see this line item being presented in this manner. I'm a bit worried about it, so that for me is not accurate. And then secondly, the thing that I've been really hammering on, when you make an adjustment, you state clearly how much was applied for. And when you reduced the amount by say 4.2 million, then how much is it? So that is not appearing, because that for me affects the decision that we need to take. And it has not been adjusted as such. And then the other thing is to allow the surplus of 4.9 million, which is a lot. And that surplus, how can it be that that surplus is now lumped into the retail business being given a surplus of 4.1 by this distributor? 4.1 million. It's a lot, Chair. On that basis, Chairperson, I would like to dissent because those things, they affect the decision. Thank you, Chair.
Thank you, Ms. Masetti. Members, are you? Yes, Mr. Mkhize, I just wanted to make a suggestion in this, but come in.
No, I just think, Chairperson, in terms of it's one thing when we moving towards a dissension, when vis-a-vis, first of all, seeking to respond to that. Maybe that these issues can be dealt with, and then we can then move towards decision making. Like I've said, and I'm saying this thing again, please, to all the presenters, make this point very clear in terms of what was applied for vis-a-vis the adjustments, or adjustments that were taken place prior to the final lodgement of an application. Thank you.
Thank you. This is the last opportunity, Mr. Mahlamu, to come in. If not, we'll stand the matter down and give you an opportunity to go and look at these issues so that we can be given fuller information and make a decision. Do you want to have the matter stood down and you go and address these issues and come back and give us the response?
I'm amenable to your proposal, Chair, and the members.
Okay, all right. Members, on that note, the issues that have been raised, the team will go and look at them and come back at the last round of our application to present them. On that note, members, can I get an indication that you agree that we send this application down for the team to go and do the calculations and come back to us in the next set of applications? Thank you, Ms. Masetti. I do support Mr. Mkhize and Mr. Majola. Thank you. We then move on to Salt Blackie Municipality. Ms. Masike, over to you.
Chairperson, good day. I did request that Salt Blackie and Thembelihle be dealt with later, as I'm still dealing with other regulatory issues with other municipalities. Thanks.
Okay, on that note, members, may I just request that we take a 10 minutes short break, then we'll move on to the next batch of applications. And maybe let me just get to the members that they do agree with Salt Blackie and Thembelihle to be stood down for Ms. Masike to do what she wants to cover that is linked to points raised by members. Thank you. Members, let's just take a 10 minutes break and be back at around 10 past 12, and then we will proceed. To IT, may you pause the streaming, and to the members of the public that are following us, we will be taking that 10 minutes break. We'll be coming back at 10 past 12. Thank you so much. Ms. Maputa, let me know.